It's Satovsky. Hope you had a wonderful holiday season and are looking forward to 2026. I know that we are. The beginning of the year is a convenient time to take stock of what happened the previous year and incorporate learnings for the future. One lesson that was reinforced this year: there's always a new surprise. This year it was the Liberation Day tariffs in April, which we highlighted in our second quarter 2025 letter. While the Trump administration had been highlighting their desire for tariffs, the tariffs were more widespread and higher than expected. The US market declined 20%, and the dollar declined for much of the year. The VIX, a commonly cited volatility index, spiked from 21 to 52 in only 4 days. In our first quarter 2025 letter, published in April, we showed you this chart, which highlighted how good the market returns were historically after the VIX was elevated. Just how quickly did people become fearful? This was the third largest spike in the VIX since 1990. As Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. You can see from the previous two charts, returns were abnormally high after nearly all those episodes of high and increasing volatility. That happened last year as well. At its peak in mid-December, the market was up 43% from the low on April 7th. One of the reasons the market was so strong through the last 3 quarters of 2025 was that expectations for GDP growth were too low. Even in January, before the Liberation Day tariffs were announced, growth expectations for the second and third quarters of 2025 were between 1% and 2%, but actual growth turned out to be close to 4%. There are concerns, as always. The first is that we are now in what economists are calling the K-shaped economy, where the rich are getting richer, but the poor are struggling even more than before. There's a decent amount of evidence to support this theory. As an example, see the chart below, which shows lower wage growth for the bottom quartile of income earners than the other three quartiles. But what the chart also shows is that even at the lowest income levels, average hourly earnings are still growing more than inflation, which is a good sign for the economy overall. Another concern is that inflation is higher than the Fed's 2% target. And while the latest data point showed a decline in the rate of inflation to 2.7%, some are questioning whether the data is accurate after the government shutdown. In addition, unemployment has been rising. While still well below historical levels, the trend of unemployment increases is concerning. Indeed, the Fed sees stagflation as the biggest risk for 2026. So why is job growth so slow when GDP growth is so strong? Apollo economist Torsten Slok postulates 3 reasons why: lower immigration, AI implementation, and fewer government jobs. I think there's a lot of truth to this, and we'll see how it plays out over the next several quarters. But what is clear is that so far, whatever negative effects are coming from the trade war is being more than offset by the AI boom and its after effects. And you're seeing it in other areas as well. Credit delinquency rates are stable to improving, and default rates for high-yield debt and loans have declined off their recent peak. Moreover, CBO estimates that the One Big Beautiful Bill will boost GDP growth by almost a full percentage point in 2026. Overall, the economy looks pretty strong heading into 2026. Okay, private assets. We've spoken multiple times about private assets and why we are skeptical of the seemingly inflated claims its backers make. We recently came across an article which highlighted one of the issues: that private funds get to mark their holdings to whatever they think the value is. Yes, they often get independent valuation experts to opine on the value of individual assets. But for many private credit funds that are traded on a public exchange, so-called business development companies or BDCs, the prices in the market are lower than the net asset values as determined by the manager. Indeed, when Blue Owl, a very large private credit player, tried to merge a private BDC with its public BDC, the price of the public one declined far enough that Blue Owl scratched the whole merger. There is some irony in that an effort to give their investors liquidity by listing these funds in public exchanges, one of their biggest marketed benefits, which is their lower volatility, goes away. What caught our eye this quarter? For those new to my letters, I always like to include some funny stories that happened during the quarter, which are unrelated to the general investment climate. My goal in the stories is to get you, the listener, to laugh. For this quarter, the theme behind these stories is counterproductive incentives. One of the more recent frauds was when Frank, a student financial aid assistance company led by Charlie Javis, sold itself to JP Morgan for $175 million, in part by claiming it had millions more users than it did. Despite the fraud, a court ruled that JP Morgan was contractually obligated to pay Javis's legal bills. With a blank check, Javis engaged 5 different law firms and ran up legal bills totaling $60 million. But the charges weren't just for her defense. JP Morgan claimed that she charged luxury hotel upgrades, extravagant meals, and even cellulite butter to JP Morgan as part of her legal costs. I guess she felt when someone else is paying, especially someone accusing you of fraud, why not throw in a few extra expenses? She ended up being sentenced to 7 years in prison. I recently came across a paper called Empty Vessels Make the Most Noise, Analyst Self-Promotion Behavior and Market Outcomes. The authors claim to have shown that there is a, quote, robust negative correlation between the expressive tone conveyed in their self-presentations and forecast accuracy, especially among males and less experienced analysts. So despite their poor accuracy, clients and employers seem to be swayed by the bravado as these analysts' calls move markets more, and they get promoted faster than their less self-promotional peers. If you're going to move markets and get promoted faster, why not be self-promotional, even if, or maybe especially because of, you have less skill? If AI is getting more powerful, perhaps one day we'll be able to ask AI how to make us money and then tell us just to do it. Well, Anthropic asked Claude to steal crypto, and in fact, it was successful in figuring how to get some. According to a paper on its website, quote, we evaluated both Sonnet 4.5 and GPT-5 in simulation against 2,849 recently deployed contracts with any prior known vulnerabilities. Both agents uncovered 2 novel 0-day vulnerabilities and produced exploits worth $3,694, with GPT-5 doing so at an API cost of $3,476. And so what was their conclusion? You need even more AI to protect yourself from AI. Of course. Okay, personnel updates. We are very fortunate that Saoirse Levitt recently agreed to permanently join our team, and Madeline Parks joined our team in early January. Saoirse will be primarily working on the development of FinDash, and she's already made huge improvements in the software. Madeline will be supporting all of us and our clients in a variety of areas. When you meet them, you'll know why we are all so excited they agreed to join us. Please join me in welcoming both of them when you speak with them, as you're bound to do soon. And finally, we're excited that Trinity Collins has taken on a new role as Client Service Associate on our operations team. Congratulations to Trinity. Thanks to all of you for your trust in our partnership. We are grateful to have such an incredible ecosystem of long-term partners, often for multiple generations. Your trust in the Satovsky team is our greatest asset, and we're fully committed to steering you through your financial journey. Please don't hesitate to reach out. Your peace of mind and your financial security is our priority. Happy New Year, everyone, and see you next quarter.